And it's super important who you give your money to by far, no matter what the deal is, the split is, that's the number one, right? I always say you bet on the jockey, and then you bet on the horse, which is the asset class. Then you bet on the track, which is the geography, right? And the geography can be countries, it can be states, it can be as micro as neighborhoods, right? There's certain neighborhoods I won't invest in, right? I try to look at crime data, income levels.
Hello, and welcome back to The Very Real Estate Effect, a podcast dedicated to real estate investing right here in Quebec. And yet today, we have a fellow Canadian who lives in the US. I'd like to introduce my friend Trevor Thompson. Hi, Trevor. Welcome to the show.
I'm honored to be here. Thanks for having me.
So I'm really excited that you're here because as a fellow Canadian who now lives in the US, it's okay. I understand there's a lot of opportunity down south of the border. You are the Vice President of Investor Engagement with your group, and you have been participating and done over 20 syndications, 1,500 units, and I'm really happy to share some of your knowledge today. So first of all, how in the world did you get started in real estate investing?
Yeah, so it was very interesting. So I was always interested in real estate, but like everybody else, I was afraid of toilets, tenants, and trash. And so I thought, I can't even get anybody to fix my house. Why do I want to make that a job? And then, I was always interested, always paid attention to it. Then I read Rich Dad, Poor Dad by Robert Kiyosaki, and it kind of opened my mind a lot more with a different way to look at it. But to be honest, I got a thick head, so it took me a while to get going. I still didn't do anything. And then one day at work, we got bought out by a private equity company, and I had a payday, and I paid a huge amount of income tax. And I thought, wait a minute now. You've known for all of these years that you need to be understanding passively investing in real estate. You just got to figure it out. So I started going to a couple of weekend webinars or meetups, and then I finally heard this model called syndication. And it was like, boom, where in the world have you been my whole life? Because I understood the business model, right? Because I was doing it in my professional career, buying businesses, fixing them up, improving their systems and efficiencies, adding some capital, and then increasing the value. So it all started to come together. And I went, wait a minute now. So I take a little bit of my money, I give it to people that know what they're doing. They're going to combine my money with bank debt, buy a real asset. So I actually own a piece of a property. And then they're going to improve the operation, fix it up, make it a better place to live for people, which is a double win-win. And I'm going to make money doing this, and I don't have to do anything. And it was like, where have you been my whole life? So again, I've only been investing 5 years. I've invested in 21 syndications. 7 of them have gone full cycle in the 5 years. But once I got hooked, I was hooked. I mean, it was like, wow, why in the world did I, and I started out dabbling just like everybody does, and then 2020 came, and we all know what happened to the stock market. And I woke up in the morning and I was a third of my net worth was gone. And I thought, why do you keep waiting? What's wrong with you? So I waited till it grew a little bit. And now I'm all in on the real estate game, not just multifamily. I'm a little diversified by asset class and location, which I think you should do once you start getting into, more and more deals. But unfortunately, nothing in Canada. It's really tough to get the numbers to work. And when I say out and about, everybody knows I actually really am a Canadian. So I was born in Niagara Falls. My personal company is actually called Niagara Investments, LLC, after my home of Niagara Falls. So
so now I understand, when you say it's a lot harder to make the numbers work in Canada. And the first thing was like, oh yeah, because I know how in the US things seem very I don't want to say cheap, because it's got nothing to do with that, but sometimes a lot more accessible. But I really want to kind of focus on the experience that you have on the
Yeah.
syndication. So you've explained the process pretty well. Now, I take it that you've been able to participate in this over 20 syndications. Was that
Yes.
all of your capital, or you're raising capital as well?
So now I'm raising capital as a general partner. So I'm on 6 deals as a general partner. In fact, raising capital right now for 4 of those. One, we're just about done. We got one little spot left. And again, I'm also diversified in where I'm raising capital. But I still continue to passively invest right now, mostly in our own deals. But I'll still always invest outside of our system because I think it just gives you that diversification, right? To not put all of your eggs in your own basket, but to be able to, get some specialists, get some out of different markets that we're not investing in, and invest with those people.
Yeah. And you also mentioned like to diversify in terms of location and asset
Yeah.
class. So you have some in residential, some in commercial, some industrial.
Yeah, so I did one residential one. It's already gone full cycle with limited returns. It kind of got caught up in the rapid increase of real estate prices here, and their buy box just blew up. So it was a syndication to buy single family homes, and the concept was it was the 1% rent rule. They were buying, ARV $200,000 homes with, if you can imagine, in Texas 3 years ago, you can still buy $200,000 homes, which is mind
Wow.
boggling.
Yeah.
Wasn't in big city markets, but you still could buy nice, 1,600 square feet, 3 bedroom, 2 bath homes. It's kind of crazy. So, but I've diversified in location. So I'm in Texas, Arizona, North and South Carolina, and Georgia. And the reasons I'm in those locations is, first of all, rapid growth markets,
Mhm.
pro business, pro landlord states. So
Yeah.
those are the things that, again, I look for. Doesn't mean people don't make money in California. It just means I'd rather not try to figure California out, which is, I always joke, sorry, I'm going to insult you Canadians, that Canada makes California look liberal
Yeah.
because
That's true.
California, U.S. is very liberal, and Canada is definitely. And I've been gone now almost 20 something years, and so it's gone a lot. I still have a daughter up there and some brother-in-laws and a sister, so I stay very well in touch. But it's certainly more socialized even when I live there.
Yeah. And so now on those deal that you have that you're a general partner on, can you
Yes.
kind of walk us through the structure?
Yeah, so most of our deals, so the good portion of the deals are value add multifamily.
Hmm.
And so they're typical deals, right? Where you buy a C-class property that's mismanaged and you put some capital into the deals to fix them up. All of them to date have been loan assumptions because of the interest rates going high. And there was a lot of loan, they still kind of got out making some money, but they were about to get into, not making as much money. So been able to buy them that way. So do value add. And so that's traditionally, but then I've also done a land entitlement deal here near Austin where we've entitled some land for 110 townhomes. And then I'm working on a very high-end, unique property. It's called X Space, but it's a deal that we're working on right now, and it's super luxury slash work warehouse industrial office space. And I mean, to give you an idea how high end it is, it's very much geared to exotic car owners. There's car elevators that bring your car right, so you park right out front of your office. It's absolutely
Wow.
bizarre.
Yeah.
But
And there's
it's
a market for that.
there is a market for that, and especially in big cities. And
Yeah.
yeah, it's very unique. So that's one of the ones we're working on now. Super fun. And then on the diversification side, so I have a retail investment, I have a medical center investment, I have everything from land entitlement to value add multifamily to A plus new build. So I'm
Hmm.
across all the spectrums of the asset classes and from value add to new build. And then I'm on a new build project in Charlotte, North Carolina of storage units. So
Okay.
again, diversifying in a couple of asset classes. And a lot of the reason I do that, and I like to explain this to people, especially when you're getting into multiple investments. I always say, pretend you're playing baseball. And if you always go for a home run or a grand slam, the chances of you striking out are a little higher. So be comfortable with a couple of singles. So, for
Yeah.
example, my medical center, it's something called a triple net lease, which means the tenants pay all of the expenses. It's actually double guaranteed. So the doctor personally guarantees it and his practice guarantees it. So there's nothing sweeter than a double guaranteed triple net lease. And that particular opportunity just pays a 10% pref. But to me, that's a home run, like, sorry, a single all day long, right? Every
Yeah.
quarter, my money comes, my money's safe. I used it for US, you can use your retirement money for investments. So I used my retirement money there. Don't want to risk it. You don't get the advantages of depreciation and some of the other things with your retirement money, anyways. I also use that for the land development deals. And then, obviously I had the value add multifamily. And then there reached a moment in time where, the cost to buy and the cost to build, the delta shrunk. And so I
Yeah.
invested in a couple of new builds. So I invested in one bought from a developer. And when you buy from a developer, there's a lot of loss to lease and concessions because you ramp it up to fill it because you're filling 300 units in, 3 months or whatever. And as an owner, you burn those off. And then I did one, which is a new build. And the same thing will happen is they'll build it, they'll ramp it up to about 80% and then sell it to an operator.
Yeah.
And so those are, and when you're looking at those deals, you're kind of buying the sweet spot of the ramp up chart, right? So value add, you're buying a property and selling it before it needs any more capex, right? That's the little sweet spot. And then the next guy says, okay, I can rinse and repeat. So I've done a lot of the different things. And then, clearly value add is where you can do very well.
Hmm.
So I had one deal, 20 months, tripled my money. Super happy there. But I
Yeah.
did have another deal where they lost my money. Something happened with the property. So on average, everything is performing well. It's a little
Hmm.
tougher right now with the interest rates and a few other things, but on average, I'm doing well. But I always try to tell people to balance out your portfolio.
Yeah. Just one question. You mentioned on the multifamily value add deals. Hoping we can dive into a little deeper in how you structure them. Like, what is usually a typical split that you do
Yeah.
on a GP LP, and what's your equities, your financial stack like?
Yeah, so our deals are all very, very similar. So they're a 70-30 split with a 7% pref. So the pref means that the investors get paid first, 7% of the cash flow. And what a
Mhm.
lot of people need to understand on multifamily value add, that means us as general partners, we're really not making nothing till year 3, 4, 5, maybe if at all, and we're making most of our money on the end.
Yeah.
We produce, or we don't guarantee. We say that a 17% IRR, which is the internal rate of return, it's anything after 17%, the split goes to 50-50. Okay,
Okay.
so what it is so basically we keep 30 cents on every dollar we make once we make it, but we pay the investors 7%, 7 cents on every dollar first. So they get paid first. Then if we achieve greater than 17%, us as a sponsorship team make more. So a lot of people go, wow, 50-50 split. That's ridiculous. And I'm like, well, it's
No, it's
not
not.
if you think of the way we've organized it. So we've
No.
done all the work, we put all the risk money in it. We also invest our own money in those deals. We pay the investors first. So again, on a value add, to get 7% cash on cash, it takes, so you're working for free for a few years, but that's
Yep.
okay. And then if you achieve it, and our goal, of course, is and you got to remember, the 50-50 split still has to produce a more than 17 IRR. So it creates a hurdle. So I call it kind of the double win, right? So investors win by getting paid first, and then we win if we achieve greater than promised results.
Mhm.
And that's how most of our deals are structured.
Okay, and that seems fairly enticing as an investor, and that I guess that's a whole other conversation. Is
Yeah.
how in investors, what I've seen so far in my capital raising experience is that people are interested, yes, in the deal and the location and the asset class and the returns and stuff, but it's who
Yeah.
and they're
Who is,
investing in someone, they're investing in a team. And sometimes, like when you talk to investors, you may have like 30 minutes or an hour, and it's not always easy to convey that message that whatever happens, you're going to be there for them.
yeah. And you know, it's interesting. I had a friend call me the other day. I'm investing in this deal because it's a 90-10 split. And I said, don't do it. And they said, what do you mean don't do it? The sponsor's never going to make any money, so he's going to lose interest in your deal because he's only making 10 cents on the dollar. This is a new person that needs to do this to attract investors. Don't do it. I had another group of friends that were on a deal that had a 12 pref, and I was like, don't do it. And they're like, why? It's a 12 pref. And I'm like, 12 pref doesn't mean they pay you 12%. It means you get the first 12%. So what happens is the sponsor can lose interest. Even the most diligent sponsor, 3 years of making, 4 years of making no money. And then let's say things get tough and they may make no money or very little money. You want them to be motivated to make as much money as possible on your win, right? That's on
Yeah.
your win. So even the storage, for example, when they double my money, it goes to a 50-50 split. And I'm like, double my money, baby, double
Go
my
for
money.
it.
I'm like, please do it and do it as fast as you can. You know, and it's more of a long term, like a 7-year hold. But for me, the concept is they're going to try to get us out on a 3 year, and then we'll stay in for what we refer to as infinite returns, right? When
Yeah.
you've got your money back. And yes, we'll be diluted to a 50-50 split, but only once I double my money, I'm like,
Yeah.
sign me up all day long for a deal like that because I want a win-win, right?
Mhm. Yeah, and that's, it's nice to hear you say that, because I find so many people, they look at it and say a 50-50 split. Well, that's not fair. It's like, it
Yeah,
completely is. Don't forget that, as you mentioned, like the sponsor, he's been working on this for 3 years. He might have
yeah,
taken a small acquisition fee, but there's been nothing since. And we're
yeah,
actually working on a deal here for a 225 unit, and there's been some questions like that on how to properly split it, and making
yeah,
sure that the sponsors are really motivated to do this in about a 4-year turnaround.
yeah. And it's super important, and it's just, and again, who you give your money to by far, no matter what the deal is, the split is, that's the number one, right? You know, I always say you bet on the jockey, and then you bet on the horse, which is the asset class, then you bet on the track, which is the geography, right? And the
Mm-hmm.
geography can be countries, it can be states, it can be
Yeah.
as micro as neighborhoods, right?
Mm-hmm.
You know, there's certain neighborhoods I won't invest in, right? I try to look at crime data, income levels, and you know, those are the things that I use to, you know, to vet deals. Especially for a while there, when rents were going ballistic, people were saying, "Oh, we're charging 700 now, we're going to charge 1,200," and then you do a look at the economics of the area, and 3 times rent is 1,000. How
Yeah.
you can't have people pay more than 3 times rent. You know, at least you don't want to because they're going
Mm-hmm.
to struggle to pay the rent, right? And
Yeah.
you know,
So,
so it's super challenging. So that's why the where makes some sense, right? You
mm-hmm.
know, our property that I'm one of the ones I'm an asset manager on, it's not in, you know, it's not in a very wealthy neighborhood, but we know that, right? We were like 750 rents going to 1,100, and you know, but 1,400 was 3 times rent, so we still had room, right? And we weren't going to be at the top of the C class market. You don't want to be the highest rent for the most average property.
no,
You just don't ever.
no. You talked a little bit earlier about, like, some of the deal structure that you do, and some of the investors and some friends coming to you, be like, giving you some term, be like, don't do it. This is a red flag. As there's a few people that are listening to this podcast that are actually in the process of raising capital, what would be a few pieces of advice you would give them? It may be like their second or third deal, and it might have been like the biggest acquisition they're doing. What would be like 3 nuggets that you would share to be like to say, like, if you want to be successful, and if you have, let's say, $1 million to raise, watch out for this.
Yeah, so first of all, you got to know your audience, right? And you got to, well, first, let's say even back it up a little bit. You got to know your deal, right? You got to, so many times now I'll get on a phone with a capital raiser from someone, and they don't even know the answers to the questions. I mean, and again, I know I'm a pretty sophisticated investor with lots of deals, but I'm certainly, I've got a friend who's in 46 deals, if you can imagine, huge number of deals. But you got to know your numbers, know your product. Make sure you partner with a good team that you want to stay in business with for 5 years, right? Because we're all eager to get on our first deal. And I'll tell you, my first GP deal, I lost 75,000 hard money. The other partner, we lost total of 350 hard money on a deal, and 75 of it was mine. My second property, we couldn't complete the raise. And to be honest, the when interest rates went as crazy as they did here in the US, thank goodness we didn't, because we only had an 18-month bridge, if you can imagine. And we would have, chances are I could have lost investor money. And then, a few other deals since then, I've learned a lot. So again, if you're raising money, make sure you know the answers, but don't lie. If you don't know the answers, say, I'll find out, right? I sit on all of the calls, and I still got to eventually go find somebody to get an answer to a certain question, because I just don't know. So never do it. Make sure you're presenting, no deal fits one size, right? So make sure that you're not trying to fit a round peg into a square hole, right? It just doesn't work, right? Some people need different things. Right now, it's tough to get cash flow, super tough. And some people, that's all, I'm going to invest in a cash flowing deal. Well, my 10 times multiples cash flowing deal is just light at 10%, right? But it's just because there's no upside to it, but it's okay. Then you should invest in something like that. I always want to make sure that I know people, and the biggest thing as a capital raiser is to never forget that you are producing an opportunity for someone to achieve financial independence. Never lose sight of that. You are helping them achieve financial independence. And let me just give an example of financial independence, right? We talk about doubling your money every 5 years, right? And that goes to my other thing. Don't wait to buy real estate and wait.
And wait.
You took $100,000 and invested it in 5 years, became 2. Invested it again, 5 years becomes 4. Becomes 8, becomes 1.6 million, becomes 3.2 million in 30 years, assuming no tax implications, you double your money every 5 years. That's life altering, right? That is creating financial independence. So that's why I always say, don't wait to buy real estate and wait. And even if you're getting in at smaller deals, at smaller things, and then a lot of people saying, well, I want to do this full time. Well, that's great, but wait until you're producing enough income where it's making more money than you need to live on. Because if you're always struggling to find the money to live on, you may take a subpar deal, pass it on to your investors, and boy, you're just not going to be successful with that kind of model, right? And especially in tough times right now with higher interest rates, inflation, some other things. Back in the 5 years ago, almost everybody was making money, and it will be that way again. I have no doubt. But just be careful.
Yeah, and I find it brings up a good point, is that sometimes there's also the tendency to be fundraising, and then you actually have capital that you need to deploy, and because that capital, you don't want it to sit for too long, then you do have the incentive to deploy into a subpar deal that may not be the best, just because you have that pressure from your investors, and that's not really good either on the backside.
Yeah, and I would say the biggest mistake I made was I collected a database, but I didn't necessarily pre-qualify people. I didn't get down to, hey, Alex, let me ask you, where are you at financially? What's your net worth? How much money are you liquid? And then I was like amazed how many people ghosted me on my first raise, like ghosted me. And it was probably because I didn't have the tough questions. And then now I'm asking for money. They're somewhat embarrassed. And so you want to get the embarrassing stuff out of the way before you're asking money. Because it's hard to talk about money, right? We were always told that there's some things, you know, you don't talk about at the dinner table, right? And money was one of them, and so it's a little bit challenging. So get your investors comfortable with that, and then when you know that you've got it, then it's different.
Mm-hmm. And I find it's interesting that you say like, oh, a lot of people ghosted me because people say, oh, I have a list of 2,000 people. Yeah, 2,000 people. Okay, but out of that 2,000, you really have 30 that are
Yeah,
gonna that are actually able to that have capital right now, that are able to deploy, that
yeah,
aren't going to be a pain in the butt, and excuse my term, but some they may be able to deploy. You don't want them with you
yeah,
because they're going to call you every second day. And
yeah,
so it's not really a matter of how big that list is the quality, is the relationship that you have with them, where you can just call up and be like, hey, I know we haven't spoken in 6 months, but I have a good deal. I need to know by Friday.
yeah.
You have a lot of experience, and that's really encouraging. As you said, you started a little bit later in your life, and now you're really enjoying it, and it really shows. If people want to find out more about you and some of your opportunities, what's the best way for them to reach
So
out?
the easiest one is LinkedIn. You just got to remember the K Trevor Thompson. And you know, if you may put some sort of note, I heard you on a podcast or whatever it is. Facebook, I'm a little less because I'm at close to that 5,000 limit, you know, and so I'm more selective. And then I'm starting to figure out Instagram. I haven't quite figured that one out, but LinkedIn is the best way to reach me because
Okay.
I'm super active there.
Okay, well, that's good to know. So, to anyone listening, if you want to get in touch with Trevor, hit him up on LinkedIn, Trevor Thompson, and you'll be able to get a hold of him. So, Trevor, thank you very much for your time today. It's been a real pleasure.
It was my pleasure. I really enjoyed it. Thank you.
Thank you very much. And to everyone listening, as usual, if you feel like this conversation could benefit someone that you know, a friend, a family member, or just want to recommend it, please send it to them. Leave us a review and subscribe to the show. It always goes a long way in helping us reach out to more people. So keep on following. And on Instagram, you can find me at Monaxel, Monsaxel, and on LinkedIn as well, Real Estate Effects. Thank you very much. I'll talk to you next week. And as usual, keep researching your market. Thank you.